In this video we are going to talk about great dividend stocks. So before starting, please like this video and subscribe to this channel for our future updates. Of course, reversing a 7.5% increase in the price of goods and services is not straightforward. That's where an ultra-high yield dividend stock portfolio comes into play, as previously stated. The following 5 dividend stocks all have yields of at least 7%, and they can be used to build an inflation-crushing portfolio with an average yield of 8.7%, which is ideal for income-seeking investors. First, let's take a look at the top 6 highest-paying dividend stocks. Number 6. Annaly Capital Management Incorporated, NLY. A diversified capital management organization, Annaly Capital Management invests in and lends money to the development of residential and commercial property. Agency mortgage-backed securities, MBS, residential real estate, and middle-market lending are just a few of the assets it has under management. The overall value of the company's assets is estimated to be roughly $89 billion. According to an announcement made on December 14 by Annaly Capital, Ilker Erdes has been promoted to the role of Chief Investment Officer, effective immediately. Among other things, Erdes will be in charge of monitoring all of Annaly's investment strategies, which will include capital allocation, growth efforts, and the general administration of the company's investment portfolio. He had previously worked at Annaly as the company's Director of Securitized Products. Number 5. Altria Group, 7.02% yield. Investment in Altria Group, the world's largest tobacco company, is the fifth and final high-yield dividend investment that can assist investors beat the effects of inflationary pressures, NYSE, MO. However, despite the fact that Altria's stock price has risen by only 324% over the past 20 years, the company's total return, which includes dividends, has soared by almost 3,200% during the same period, according to the most recent available data. That is an example of the effectiveness of dividends in action. At least in terms of price appreciation, the apex of tobacco stocks growth has come and gone in the last several months. Adult smoking rates in the United States have declined dramatically over time as a result of increased public awareness of the dangers of nicotine use and the health implications of using it. While millions of smokers have abandoned their habit, the millions of smokers who have stayed are willing to endure price hikes on an ongoing basis in order to preserve their addiction. Despite a 7.5% reduction in cigarette shipments for the same period the previous year, the tobacco corporation Altria recorded a 1% decline in revenue from smokable goods for the entire year of 2021. Having such extraordinary pricing power has a positive impact on the company's dividend payment ratio. Also noteworthy is that Altria has shown no reluctance to make investments in the company's long-term success. The corporation has made major investments in vape startup Juul and Canadian cannabis stock Cronos Group, as well as significant interests in heated tobacco and smokeless items. However, despite the fact that these are now tiny revenue sources, they have the potential to grow at a substantially faster rate than the company's traditional tobacco sector in the future. Number 4. Sabra Healthcare REIT, 8.93% yield. In addition to Sabra Healthcare REIT, NYSE, SBRA, investors can purchase a fourth ultra-high-yield dividend company, which they can use to form an inflation-crushing portfolio, NASDAQ, SBRA. Sabra rents out more than 400 healthcare assets to a variety of healthcare organizations, including skilled nursing facilities and senior living communities. What should have been expected was that the coronavirus outbreak would cause significant damage to Sabra Healthcare. Given the fact that COVID-19 has had a disproportionately unfavorable impact on older citizens, there was genuine concern about the ability of the company's lessees to make their rent payments. One encouraging piece of information to share is that occupancy rates in skilled nursing facilities and senior housing have both fallen to levels last seen more than a year ago. As a result, the firm has been able to collect 99.6% of its anticipated rents when the pandemic first broke out in 2009. Number 3. New Residential Investment Corporation, NRZ. New Residential Investment is a mortgage REIT, real estate investment trust, real estate investment trust. It provides funds and services to the mortgage and financial services industries, and it does so in a cost-effective manner. As part of its long-term cash flow strategy, the firm invests in assets that create steady cash flows over time. The company's investment portfolio includes non-agency securities, residential loans, and other closely connected investments, in addition to mortgage servicing-related assets and other assets. Genesis Capital LLC, a business purpose lender, as well as a related loan portfolio, were acquired by New Residential Investment from the Genesis Capital LLC owners, according to a statement released in December. Genesis' efforts to increase its footprint in the United States housing market, notably in the built-to-rent space segment, are anticipated to be aided by the acquisition. It was not made public at the time that the financial specifications of the acquisition, which was announced in October, were not made public at the time. Number 2. Pennant Park Floating Rate Capital, 8.78% yield. In case you're looking for something that's completely off the radar of most income investors, Pennant Park Floating Rate Capital, NASDAQ, PFLT, is an ultra-high-yield dividend investment that you should look into further. A business development company, BDC, is a company that specializes in business development, NASDAQ, PFLT. It's also one of the corporations that pays out the highest monthly dividend yields of any of the companies in the sector. Pennant Park primarily invests in first lien secured loans in middle market companies, that is, publicly traded companies with market valuations between $2 billion and $5 billion, and has a particular emphasis on middle market companies. Consequently, it focused on the middle market niche because lending options for small and medium-sized businesses are often limited. In other words, Pennant Park derives significant financial benefits from the debt that it owes. Number 1. Enterprise Products Partners, 7.62% yield. It is possible that some income searchers are wary of putting their money to work in the oil industry as a result of what happened during the pandemic. In contrast, midstream behemoths like Enterprise Products Partners were mostly unscathed by the record-breaking demand slowdown that slammed upstream drillers and explorers, NYSE, EPD. Enterprise Products Partners is a middleman in the energy market that provides a variety of services. According to industry estimates, it has responsibility over more than 50,000 miles of oil and gas transmission pipeline and approximately 14 billion cubic feet of natural gas storage space. Because the company engages into fee-based contracts with upstream companies well in advance, its cash flow is quite predictable, regardless of how volatile crude oil or natural gas prices may become in the future, according to the company. As evidenced by the fact that Enterprise Products Partners' distribution coverage ratio, i.e., the amount of distributable cash flow divided by the amount of dividends paid to shareholders, never fell below 1.6 during the peak period of the pandemic, the company's operating model has proven to be extremely safe in times of crisis. When the payout coverage ratio is less than 1, it indicates that the payout is not financially sustainable. Because Enterprise Products Partners has consistently increased its base yearly dividend for the past 23 years, the company has established itself as one of the most trustworthy income stocks you'll find in the energy market. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.